Welcome back to Wealth in Pages, where we simplify money, mindset, and mastery. This is part 4 of our breakdown of Money, Master the Game by Tony Robbins, and today, we're going to make your financial future clear and winnable. But before we dive in, if you're finding value in this series, don't forget to like, share, and subscribe to support the channel and help more people master their money. Let's get started. Thought. We've all heard stories from 2008 of people who had all their money in real estate or the stock market and got completely wiped out. The old saying, "Don't put all your eggs in one basket," is more than just a cliché. It's the most important rule for financial survival. Proper diversification across different types of assets is what protects you from those devastating losses. It's what lets you sleep at night. So, how do you do it? Tony Robbins breaks it down into a simple but powerful framework. Think of your money as going into two big buckets. The first and most important is your security peace of mind bucket. This is the core of your financial life. It's where you put the money you absolutely cannot afford to lose. This isn't about getting rich quick. It's the slow and steady turtle that ultimately wins the race. So, what goes in here? Cash. You need an emergency fund, something liquid for unexpected events. Bonds and CDs. These are essentially IUS from governments or corporations that provide a fixed predictable return. We're talking about the safer kind here. Your home, your primary residence, belongs in this bucket. It's a sanctuary, not something to speculate with. Pensions and certain annuities. If you're lucky enough to have a pension, that's pure security. And certain types of modern annuities can act like a personal pension, giving you a guaranteed income for life. Structured notes and market-linked CDs. These are some of the insider tools. They're products offered by major banks that give you 100% protection on your principal while still letting you participate in some of the stock market's gains. You get the upside without the downside risk. The goal of this bucket is right in the name: security and peace of mind. It's the foundation that allows you to take calculated risks elsewhere. A big piece of that security bucket is bonds. Now, bonds have gotten a bad rap lately with interest rates being so low, but they are still a critical part of a balanced portfolio. You have US Treasuries, which are considered the safest on the planet because they're backed by the government. There are corporate bonds, which are IUS from companies. The risk and reward here depend on the financial health of the company. And there are municipal bonds issued by states and cities, which have the huge advantage of often being tax-free. Understanding these basic building blocks is the first step. You don't have to be an expert, but knowing what tools are available is key. In the end, asset allocation is about creating the right mix of these different assets to match your personal goals and your stage of life. It's the one skill that can truly set you up for a lifetime of financial success. Playing to win, the risk growth bucket. We've talked a lot about the security bucket, the safe, steady foundation of your financial life. But now, let's talk about the fun part, the part that gets all the attention, the risk growth bucket. This is where the magic can happen. It's sexy. It's exciting. And it's where you have the potential for much higher returns. But you have to remember the first word in the name is risk. Growth is not guaranteed, but risk is. The greatest investors know that markets run in cycles. What goes up will come down. Ray Dalio famously said that whatever your favorite investment is, you can count on it dropping 50% to 70% at some point in your life. This bucket is where you play to win, but you have to go in with your eyes wide open. So, what are the tools we have in this high-octane part of our portfolio? There are several key asset classes to consider. 1. Equities. This is just a fancy word for stocks. You can own individual companies or more commonly a bundle of them through things like index funds or ETFs. 2. High-yield bonds. You might know these by their old name, junk bonds. They offer higher interest payments because you're taking on a lot more risk that the company might not be able to pay you back. 3. Real estate. This isn't your primary home, which is in your security bucket. This is investment real estate. Things like rental properties are more accessibly right, which are real estate investment trusts that trade like stocks and let you own a piece of large commercial properties. 4. Commodities. Think gold, silver, oil. Gold has traditionally been seen as a safe haven, but as its price swings show, it can be very volatile. It offers no income, so you're purely betting that its price will go up. 5. Currencies. This is pure speculation on the value of one country's money versus another. It's a game for the pros and not for the faint of heart. 6. Collectibles. This includes things like art, wine, and classic cars. It requires very specialized knowledge. 7. Riskier structured notes. Remember the structured notes with 100% principal protection. There are other versions that offer you a much bigger piece of the market's upside in exchange for only partial protection on the downside. Higher risk, higher potential reward. So, how do you put all these pieces together? To give us a blueprint, Tony Robbins shares the personal portfolio recommendation from one of the greatest institutional investors of all time, David Swensen, the man who manages Yale University's multi-billion-dollar endowment. His model for individuals is elegant and simple, using just 6 types of index funds. But what's shocking to many is the allocation. He recommends putting 70% of your portfolio in the risk to growth bucket. That's aggressive. His logic is that over long periods, equities have historically provided superior returns. His recommended mix is highly diversified across U.S. stocks, international stocks, emerging markets, and real estate. The other 30% is in the security bucket, split between regular treasury bonds and inflation-protected bonds to protect against both deflation and inflation. When this portfolio was back-tested, it consistently beat the overall stock market with less volatility. It's a master's blueprint for long-term growth. But here's the most important question. Is David Swensen's aggressive 7030 split right for you? Your personal allocation depends entirely on your own situation and, most importantly, your true emotional tolerance for risk. Imagine you're on a game show. Would you take a guaranteed $1,000 in cash, or would you take a 5% chance at winning $100,000? There's no right answer, but your gut reaction tells you a lot about your personality. It's easy to think you have a high tolerance for risk when things are going well, but most of us don't know how we'll really react until we've taken a significant financial hit. We are biologically wired to feel the pain of a loss much more intensely than the pleasure of a win. This is why it's so critical to be honest with yourself about what you can truly handle. So, the moment of truth. What's your number? How much of your money will you put in the security bucket? And how much will you put in the risk growth bucket? Is it 50-50? Is it the aggressive 7030 like David Swensen? The most important thing is to choose a mix that not only helps you reach your financial goals, but also, as financial leader Mary Callahanos says, lets you sleep well at night. This is your decision, your plan, and your key to peace of mind. The dream bucket. So far, we've talked about the security bucket for safety and the risk or growth bucket for building wealth. But there's a third equally important bucket that often gets ignored, the dream bucket. This isn't about some far-off retirement goal. This is for right now. The dream bucket is where you set aside money for what Tony Robbins calls strategic splurges. The things that add juice to your life and keep you motivated on this journey. It's the new car, the season tickets, the trip you've always wanted to take. So many people have a lot of money but not much of a lifestyle because they forget to enjoy it along the way. This bucket is the cure for that. And what's the ultimate dream you can fund from this bucket? Often it's not something for yourself, but something you do for others. The most fulfilling splurges are often acts of giving. Tony Robbins shares 2 incredibly powerful stories to drive this point home. The first is about buying his mother a beachfront condo she fell in love with. He describes handing her the keys and the look of astonished, tearful joy on her face as one of the best moments of his life. The second story is even bigger. He made a promise to an entire class of 5th graders from a tough neighborhood that he would pay for their college education if they just kept up their grades, stayed out of trouble, and most importantly did community service. He made a legally binding commitment before he even knew how he would pay for it all. Why? Because, as he says, if you want to take the island, you have to burn your boats. Making that commitment unleashed the creativity and drive to make it happen. These stories show that giving isn't something you do after you're rich. It's a mindset that creates abundance. So, how do you actually fill this dream bucket without wrecking your long-term plan? There are 3 main strategies. 1. From a windfall. If you get an unexpected bonus or inheritance, you can put a piece of it directly into your dream bucket. 2. From your profits. When you have a big win in your risk growth bucket, take some of those profits off the table. Tony Robbins suggests a 1/3 rule. Put 1/3 back into security, reinvest 1/3 into risk growth, and put 1/3 into your dream bucket to enjoy today. 3. From your savings. This is the most consistent way. As you use the speed I teed up strategies to save more money by cutting fees, earning more, or being tax efficient, you can allocate a percentage of those new savings to go directly into your dream bucket. This way, you're funding your dreams without taking a single penny from the money already earmarked for your financial freedom. A story that perfectly captures the whole point of the dream bucket. It's about a frugal couple who finally go on the Caribbean cruise of a lifetime. To save money, they pack boxes of cheese and crackers and eat them in their cabin for every meal while everyone else enjoys these magnificent buffets. On the very last night, they decide to splurge and have one big fancy dinner. After they've eaten their fill, they ask for the bill. The waiter looks at them completely stunned and says, "What bill? Didn't you know the meals come with the trip? The meals come with the trip." Don't be so focused on saving for the future that you forget to enjoy the journey. That's what the dream bucket is for. It's about making sure you don't live your life on cheese and crackers when there's a feast waiting for you. Timing is everything. Everyone knows the secret to great comedy is timing. But what about investing? We're often led to believe that the secret to getting rich is knowing when to get in and when to get out of the market. The problem is, as humans, we are terrible at it. Our emotions make us do the exact wrong thing at the exact wrong time. As economist Burton Malchel pointed out, more money flowed into the stock market than ever before, right at the peak of the dot-com bubble in 2000. And when did the money come pouring out? At the absolute bottom of the market in 2002 and again during the financial crisis in 2008. We buy high out of greed and sell low out of fear. It's a recipe for disaster. But what about the pros, you might ask? Surely they can time the market. Tony Robbins shares a fascinating story that shows why even this is an illusion. He was fortunate enough to get a heads up from the legendary trader Paul Tudor Jones about the coming 2008 crash, which allowed him to warn his clients. It was an incredible accurate prediction. But a few years later in 2010, another warning about a market drop proved to be wrong. Why? Because no one, not even the best in the world, could have predicted that the Federal Reserve would step in and print an unprecedented $4 trillion to prop up the economy. The game board was changed by an unpredictable force. This proves the point. Trying to perfectly time the market is a fool's errand. So, if we can't time the market, what's the solution? It's to take your emotions out of the equation and use a disciplined, automated system. There are 3 key strategies for this. 1. Dollar cost averaging. This is a classic. Instead of trying to guess the perfect moment to invest, you simply invest a fixed amount of money at regular intervals, say every month. When the market is down, your fixed amount buys you more shares. When the market is up, it buys you fewer. Over time, this strategy turns market volatility into your friend, lowering your average cost per share. Most 401k plans do this for you automatically. 2. Rebalancing. This one takes discipline. It means that on a regular basis, maybe once or twice a year, you look at your portfolio and bring it back to your original target allocation. If your stocks have soared and are now taking up too much of your portfolio, you have to sell some of those winners and buy more of your underperforming, safer assets. It feels counterintuitive to sell what's working, but this discipline forces you to sell high and buy low, locking in gains and preventing you from getting too exposed to risk. 3. Tax loss harvesting. This is a smart insider technique. It simply means that when you rebalance, you can use some of your investment losses to offset your investment gains, which lowers your tax bill and increases your real take-home return. At the end of the day, a disciplined system will always beat emotional reactive decisions. By understanding the principles of asset allocation and using automated strategies like dollar-cost averaging and rebalancing, you can build a portfolio that thrives over the long term without ever having to predict the future. You've now learned the rules. You've made a plan. And you know the importance of asset allocation. You're no longer just guessing. You're using a time-tested system for success. Upside without the downside. Create a lifetime income plan. Invincible. Unsinkable. Unconquerable. The all-season strategy. Great investors are often forged in the fires of economic chaos. Tony Robbins tells the story of Ray Dalio, one of the greatest investors of our time. Dalio's entire philosophy was shaped by the turbulent 1970s and one shocking historical moment. Imagine sitting in your living room one night when President Nixon interrupts the broadcast to announce that the US dollar will no longer be backed by gold. Dalio, a young clerk on the stock exchange, thought for sure the market would crash the next day. Instead, it soared. That counterintuitive event taught him his most important lesson. Expect surprises. It set him on a lifelong quest to build a portfolio that could survive anything. And what he created is nothing short of the holy grail for investors. Robbins reveals the incredible historical performance of Dalio's strategy. Imagine a portfolio that has delivered nearly 10% annual returns for the last 40 years. A portfolio that made money in 85% of those years. And in its worst year, 2008, when the world was melting down, it lost less than 4%. This isn't a fantasy. It's the result of a completely different way of thinking about investing. So, how did he do it? Dalio's success comes from a relentless quest to find the truth. He created his famed all-weather strategy, not for his hedge fund clients, but for his own family's trust fund. He wanted to create an investment plan that would work long after he was gone, no matter what the future held. This led him to two groundbreaking insights that shatter conventional wisdom. First, he realized that a traditional balanced 50-50 portfolio of stocks and bonds is dangerously unbalanced. Why? Because stocks are about 3 times more volatile or risky than bonds. That 50-50 split of your money actually means about 95% of your risk is in stocks. If stocks crash, your whole portfolio goes down with them. Second, he simplified the entire economic world down to just 4 possible seasons that can affect your investments. 1. Higher than expected inflation. Prices rise. 2. Lower than expected inflation or deflation. 3. Higher than expected economic growth. 4. Lower than expected economic growth. Dalio's genius was to stop trying to predict which season is coming next and instead build a portfolio that has 25% of its risk prepared for each of those 4 seasons all the time. It's a portfolio that is truly ready for anything. So, what is the actual recipe? After much convincing, Tony Robbins got Ray Dalio to share a simplified version that any of us can use. This is the blueprint for the all-seasons portfolio. Here it is. 30% in stocks like an S&P 500 index fund, 55% in bonds split between long-term and intermediate-term U.S. government bonds, 7.5% in gold, 7.5% in commodities. It's a mix that looks very different from what most financial advisors recommend. It's heavy on bonds to balance out the high volatility of stocks, and it includes gold and commodities to protect against periods of high inflation. It's not about hoping for the best. It's about being prepared for the worst while still capturing incredible returns. It's a game-changing strategy from one of the greatest financial minds on the planet. It's time to thrive. Storm-proof returns and unrivaled results. So, we have the recipe for the all-seasons portfolio from one of the greatest investors of our time, Ray Dalio. It sounds great in theory, but the big question is, does it actually work? Tony Robbins reveals that he had a team of analysts stress test this strategy all the way back to the 1920s through every imaginable economic storm. The results are nothing short of breathtaking. Over the last 30 years, this portfolio has delivered an average return of nearly 10% a year. It made money in 86% of those years, and its worst loss was a tiny 3.9%. And that was in 2008, when the rest of the market was down by 37%. Think about that. Through the Great Depression, World War II, the dot-com bust, and the 2008 financial crisis, this portfolio has not only survived but thrived. It's the definition of a storm-proof investment strategy. Now, whenever something looks this good, the critics come out and the biggest question they ask is, what happens when interest rates go up? Won't all those bonds in the portfolio get crushed? It's a fair question, but it misses the point of the all-seasons philosophy. It's not a bet on one particular outcome. It's designed to be prepared for all outcomes. And history backs this up. During the high inflation rising rate decade of the 1970s, when interest rates were skyrocketing, the all-seasons portfolio still cranked out an average annual return of almost 10%. It passed the test with flying colors. But here's what might be the most important advantage of this strategy, and it has nothing to do with numbers. It's about human psychology. Its greatest benefit is that it protects you from your own worst enemy, fear. He tells the story of the legendary Mellon Fund run by Peter Lynch, which delivered an incredible 29% average annual return for over a decade. But a study by Fidelity found that the average investor in that fund actually lost money. How is that possible? Because they couldn't stomach the volatility. They would panic and sell when the fund was down and then full of regret buy back in after it had already gone up. Most of us think we have nerves of steel, but would you really be able to watch your life savings drop by 50%? Or 60%? And not sell? The all-seasons portfolio with its smooth and steady ride provides what Tony Robbins calls emotional scaffolding. It keeps you in the game because it prevents the kind of catastrophic losses that cause people to make disastrous emotional decisions. So the proof is in the pudding. We have a powerful proven strategy that has stood the test of time. The ball is now in your court. You can take this blueprint and implement it yourself using low-cost index funds. Or if you want help, you can work with a fiduciary advisor to put it in place for you. Tony Robbins points to automated services like the one on the Stronghold Financial website that can analyze your current portfolio for free and show you how it compares to the all-seasons approach. Whatever path you choose, the key is to take action. You are now armed with one of the most powerful investment strategies on the planet. You have a plan that can give you not only financial returns, but also what might be the most valuable asset of all, peace of mind, freedom, creating your lifetime income plan. When we think about investing, what's the end goal? Most people say growth or a big nest egg, but we're focused on the wrong thing. He uses a powerful analogy. Planning for retirement is like climbing Mount Everest. Getting to the top, accumulating all that wealth is an incredible achievement. But that's only half the battle. The most dangerous part of the climb is getting back down. And in the financial world, getting down the mountain means turning your assets into a reliable lifelong income stream. You can't spend a stock certificate or a gold bar. You can only spend cash. The real goal, the ultimate outcome that matters isn't just a pile of assets. It's income. Income is freedom. This is more critical today than ever before because the old retirement playbook is broken. For one, we're living longer than anyone could have imagined. Lifespans are pushing toward 90 or even 100. That old 4% rule for withdrawals. The Wall Street Journal ran an article titled, "Say Goodbye to the 4% Rule. It just doesn't work anymore in a world of low interest rates and longer lives." But the biggest danger, the financial world's dirty little secret, is something called the sequence of returns risk. This is a game of pure luck that can destroy your retirement. Tony Robbins tells the story of two people, John and Susan. They both retire at 65 with the exact same amount of money, $500,000. They use the exact same withdrawal strategy, and over the next 25 years, they get the exact same average rate of return from the market. But John gets unlucky. He experiences a few bad market years right at the beginning of his retirement. Those early losses are devastating because he's withdrawing money from a shrinking pot. By age 83, he's completely out of money. Susan, on the other hand, gets lucky. Her bad years come later. By the time she's 89, she's not only withdrawn nearly $1 million in income, she still has over $1.6 million left in her account. Same money, same plan, same average returns. One goes broke, the other thrives. The only difference was the timing of the market, something no one can control. So, how do you protect yourself from that terrifying game of chance? How do you guarantee you have an income for life? The solution lies in a financial tool that often gets a bad rap, annuities. Tony Robbins talked to some of the most respected financial minds in the world, like Dr. David Babbel from the Wharton School and Dr. Jeffrey Brown, an advisor to the White House and the World Bank. These aren't salespeople. They're academics who have spent their lives studying this problem. And they both concluded that for their own personal retirements, they used annuities to create a guaranteed income stream and peace of mind. Why do annuities have a bad reputation? Because they're often sold the wrong way. A broker might frame them as a low-return investment, and of course, they look terrible compared to stocks, but that's not their purpose. A study found that when you describe an annuity as a low-return investment, only 20% of people are interested. But when you describe it accurately as a tool that provides a guaranteed income for the rest of your life, just like Social Security, their appeal skyrockets to over 70%. It's about getting a paycheck you can't outlive. It's income insurance. And as we'll find out, modern versions of these products can offer incredible benefits, like participating in the market's gains without any of the downside losses. It's the solution to the sequence of returns risk and the key to turning your nest egg into a truly secure retirement. Time to win. Your income is the outcome. For a long time, annuities have been the whipping boy of the financial world. You've probably seen the ads. I hate annuities, and you should, too. They've been painted as this terrible high-fee product to be avoided at all costs. But recently, the conversation has started to shift. A few years ago, the investment magazine Barron's ran a cover story with the headline, "Best Annuities with Their Steady Income Payments. Annuities are suddenly hot. So, what's going on?" The truth is, while some annuities are terrible, lumping them all together is a huge mistake. It's about knowing the difference between the good and the bad. For people that are near retirement, the power of a simple immediate annuity is undeniable. Tony Robbins tells the story of a 65-year-old man with a $500,000 nest egg who needed a safe, guaranteed income right away. A bank CD would have paid him about $1,100 a year. Bonds would have given him about $15,000 a year, but with the risk that his principal could drop if interest rates went up. An immediate annuity, it would pay him $32,700 a year, guaranteed for the rest of his life. That's a $2,750% increase over the CD. Now, the common objection is, what if I die early? The insurance company keeps my money. But as one expert put it, if you are dead, who cares? What's painful is if you live too long with no income. That's the traditional use. But the real gameker is a modern product called a hybrid fixed indexed annuity or FIA. This is what's getting all the attention. Think of it as the holy grail for your safe money. It offers 100% protection on your principal. You can't lose a penny. But here's the magic. You also get to participate in the stock market's gains. If the market goes up, you get a piece of the upside. If the market crashes, you lose nothing. On top of that, you can add a feature called a lifetime income rider, which turns the account into your own personal pension, giving you a guaranteed paycheck for life. Tony Robbins was so blown away by this upside without the downside concept that he went on a mission. These products used to be only for wealthy people in their 50s and 60s who could make a big lump sum deposit. So he partnered with one of the largest annuity distributors in the country, a firm called Advisors Excel, and challenged them. He said, let's create a version of this for everyone. They worked with the biggest insurance companies in the world to create a new revolutionary type of FIA that younger people can get into with small monthly contributions. Just like a 401k, this new generation of products has completely changed the game. But how do you navigate this world and find the right one for you? The author gives a clear action plan. He mentions a website, lifetimeandincome.com, that was created to help people do exactly this. You can go there, get a free analysis of any annuities you already own and see what a personalized lifetime income plan would look like for you based on what you can contribute. The site can connect you with specialists who can answer your specific questions. The FAQ section of the book addresses the big concerns. What if you die early? With these new hybrid products, your entire account balance goes to your heirs. What about fees? There are no annual management fees taken from your account. The only fee is for the optional income rider if you choose to add it. What if you need your money in an emergency? You can typically withdraw up to 10 to 15% per year without a penalty. The bottom line is that a properly structured annuity can be an incredibly powerful tool. It's not about hating a product category. It's about understanding how to use the right products to secure a guaranteed income for life. Secrets of the ultra-wealthy that you can use too. Have you ever wondered why a billionaire would need a life insurance policy? The Guinness World Records noted that some mystery billionaire bought a policy worth over $200 million. It seems crazy, right? His family would be fine without it. But Tony Robbins reveals that the ultra-wealthy aren't buying life insurance for the death benefit. They're using it as a powerful legal tax shelter. It's been called the insider secret for the affluent. Think of it as a rich man's Roth IRA. Major corporations and banks like Wells Fargo park billions of dollars of their core capital in these policies. Why? Because you put in after-tax money, it grows completely tax-free. And when structured correctly, you can access it tax-free. The power of this strategy is all about eliminating the biggest drag on your investments, taxes. By taking taxes out of the equation, you can accelerate your path to financial freedom like nothing else. Tony Robbins gives a clear example. If you need $125,000 a year after tax to live, a traditional financial plan would say you need to save up about $5 million to generate that kind of income before taxes. But if your investments are growing in a tax-free environment, you only need to save $2.5 million to get the same spendable income. You literally cut your retirement savings goal in half. Or look at it another way. A $1 million investment in a taxable account might grow to $7 million over 40 years. In this tax-free structure, it could grow to over $30 million. That's the staggering power of tax-free compounding. So, how do you get access to this? This isn't about the expensive high-commission life insurance policy that your local agent might sell you. The super rich use something called private placement life insurance, or PPLI, which is an institutionally priced product with no commissions or surrender charges. For a long time, this was only available to accredited investors with very high net worths. But here's the game changer for the rest of us. There is now an accessible version of this strategy. Tony Robbins points to nonprofit organizations like TIAF, which was originally founded by Andrew Carnegie. Because of their nonprofit structure, they can offer a life insurance product that has the same powerful tax benefits, tax-free growth, and access, but without the high commissions or high net worth requirements. It's a way for anyone to use the same strategies as the billionaires. Finally, after diving into this powerful investment strategy, Tony Robbins offers one last crucial piece of advice to protect the wealth you build. It's something everyone needs, not just the rich, living, revocable trust. This is a simple legal document that ensures that if something happens to you, your assets go directly to your family without having to go through a long, expensive, and public court process called probate. It also protects you while you're alive if you become ill and can't manage your own affairs. In the past, this was an expensive legal process, but you can now get templates for free online or use a service like LegalZoom to set one up for just a few $100. It's an essential final step to make sure the legacy you build is protected for the people you love. Invest like the point. 01% The Billionaire's Playbook. Meet the masters. So after all the myths and strategies, we finally get to the main event, what Tony Robbins calls the Billionaire's Playbook. This is the part of the journey where he sits down with the masters of the universe, the greatest financial minds on the planet. For 4 years, he went on a quest to interview more than 50 of them, from self-made billionaires to Nobel Prize winners. And he asked them all the same core question. If you couldn't pass any of your money down to your children, what portfolio and what set of principles would you give them to ensure they could thrive? These masters don't all sing from the same HYMNSH sheet. They have different opinions, different strategies. There are many paths to the top of the mountain. Tony Robbins shares these cool little moments, like getting to see a friendly debate between former Treasury Secretary Larry Summers and publisher Steve Forbes, or being the one to introduce two legends, Carl Icahn and Jack Bogle, for the very first time. It just goes to show that there's no single right way to win the game. Despite all their differences in tactics, Tony Robbins found that all of these financial giants share 4 core obsessions. These are the fundamental beliefs that drive their success. First, and this is huge, don't lose money. It sounds simple, but they are absolutely obsessed with it. Legendary trader Paul Tudor Jones says that for him, defense is 10 times more important than offense. They know that if you lose 50% of your money, you have to make a 100% return just to get back to where you started. Protecting your capital is rule number 1, 2, and 3. The second obsession is to risk a little to make a lot. They are constantly hunting for what they call asymmetric risk-reward. They're not looking for a good return. They're looking for a home run where the potential upside is just massive compared to the potential downside. Paul Tudor Jones won't even make a trade unless he believes he can make $5 for every $1 he risks. Third, they anticipate and diversify. These masters do their homework like crazy. They dig deep until they know an investment inside and out. But they also have the humility to know they could still be wrong. As one of them said, by the time you get all the information, everyone else knows it and you no longer have an edge. So to protect themselves from the unknown, they diversify. And the fourth obsession is that they're never done. These are some of the wealthiest people on the planet, and they could have retired decades ago. But they never lose their hunger to learn, to grow, to earn, and most importantly to give back. They understand that true wealth isn't about what you have, it's about what you contribute. So, as we dive into these conversations, you're not just getting stock tips. You're getting a master class in how the best in the world think. You're learning the principles that will prepare you for any economic season so you can build your own path to financial freedom. Carl Ien, Master of the Universe. What if a single tweet could be worth 17 billion? That's exactly what happened when legendary investor Carl Icahn tweeted that he was buying Apple stock. The share price jumped almost instantly. Icahn, one of the most important and yes, feared investors in America. Forget the stereotype of the ruthless corporate raider. Icahn sees himself as a shareholder activist. His mission to find big underperforming companies and, as he says, shine a light on them to force change and unlock value for the average shareholder. So, how does he do it? Icahn's main strategy is to buy a huge chunk of a company and then go to war with the management. He's not shy about it. He gives the example of his public fight with Coca-Cola. The company was planning to issue billions in new stock to fund massive pay packages for its top executives. A move that would have diluted the value for every regular person holding Coke stock in their retirement account. Icahn blasted them publicly, calling out the board for being a fraternity or club where you must not ruffle feathers. His critics say he's just in it for a quick profit, that he pumps and dumps stocks. But a Harvard study actually proved the opposite. It found that when Icahn gets involved, the companies he targets are actually stronger and continue to outperform for years after he's gone. This tough-as-nails persona didn't come from nowhere. Carl Icahn wasn't born with a silver spoon. He grew up on the streets of Queens, the son of a teacher and a frustrated opera singer. He was a smart, competitive kid who paid his way through Princeton by playing poker. And that's where he learned his most important lessons. After a brief stint in the army, he hit Wall Street, made some money, bought a cool convertible, and then lost everything in the crash of 1962. But he didn't quit. He clawed his way back by mastering a complex type of trading called arbitrage. That experience, losing it all and coming back, forged the resilient, tenacious investor he is today. So, what's the playbook? How does he consistently win? He looks at companies not as tickers on a screen, but as a collection of assets, and he believes that 90% of the time, the reason a company is failing is because of bad management. He sees his job as simply getting the CEO off the golf course. He also has an incredible ability to see what other experts miss. He tells the story of his investment in Netflix. All the analysts were worried about how Netflix would pay for new content. But Icahn and his son Brett saw it differently. They looked at the billions of dollars in subscription fees coming in every year and realized the company's cash flow was much stronger than anyone believed. It was a simple observation that made them a fortune. But when you strip it all away, Ian says his motivation has changed. He says, "It may sound corny, but at this point in my life, I am trying to do something to keep our country great." He's fighting to make corporate America more accountable, and he's putting his money where his mouth is, donating millions to create charter schools that demand that same level of accountability. He's the master of the universe, fighting one battle at a time. David Swensen, a $23.9 billion labor of love. There are some investors who are household names, and then there are the quiet legends who the pros all study. Tony Robbins introduces us to one of those quiet legends, David Swensen. He's been called the Warren Buffett of institutional investing. For nearly 3 decades, he's managed Yale University's endowment, growing it from $1 billion to over $23 billion. The thing about Swensen is he's not in it for the money. He could be making exponentially more on Wall Street, but he's dedicated his life to serving the university. He's a true innovator who completely changed the game with what's known as the Yale model of investing. Swensen didn't pull any punches. He said that for the average person, the investing world is a mess. Why? He points to a fundamental conflict of interest in the mutual fund industry. The companies make more money by charging you high fees, which directly lowers your returns. He says the profits win and the investor seeking returns loses. He also explains that the performance numbers we see are incredibly misleading. The stats that show 96% of mutual funds fail to beat the market don't even include the hundreds of funds that performed so badly they went out of business. It's called survivorship bias. So the reality is even worse than we think. And on top of that, we as investors tend to shoot ourselves in the foot. We chase the hot 5-star funds and sell the ones that are doing poorly. We systematically buy high and sell low. So what's the solution to this mess? Swenson says investors only have 3 tools or levers to pull. You can try to pick the right stocks, you can try to time the market, or you can focus on asset allocation. And he says asset allocation, how you divide your money among different types of investments, is overwhelmingly the most important. In fact, he says it accounts for more than 100% of returns. How can that be? Because trying to time the market and pick stocks usually costs you money in fees and bad decisions. He quotes the father of modern portfolio theory, Harry Merowitz, who famously said, "Diversification is a free lunch." It's the one thing you can do to lower your risk without lowering your expected return. It's the key to winning. So, what does the master himself recommend? What is the David Swenson blueprint for an individual investor? It's an elegant and surprisingly simple portfolio made up of 6 low-cost index funds, but the mix is aggressive. He recommends putting 70% of your money into growth-oriented assets. Here's the recipe. 30% in US stocks, 15% in foreign developed stocks like Europe and Japan, 10% in emerging market stocks, 15% in real estate through RIAs. That's the 70% for growth. The other 30% goes into the safety of US Treasury bonds. But he splits that 30% in half. 15% in regular long-term Treasury bonds to protect against deflation and 15% in Treasury inflation-protected securities or TIPS to protect against inflation. It's a long-term equity-focused strategy designed for growth, but it's also intelligently diversified to handle whatever the economy throws at it. It's a powerful lesson from a man who isn't just playing the game. He's mastered it. John C. Bogle, the vanguard of investing. When you think of the giants of investing, a few names come to mind. But Tony Robbins introduces us to a man who might be the most important of them all for the average person. Jack Bogle. Fortune magazine named him one of the 4 investment giants of the 20th century. He's the man who founded Vanguard, and more importantly, he's the creator of the very first index fund. Today it seems obvious, but back in the 1970s, the idea of a low-cost fund that didn't try to beat the market, but simply was the market, was revolutionary. It was mocked as Bogle's folly. One competitor even called it un-American. But Bogle's logic was simple and undeniable. As a group, investors can't beat the market because they are the market. He turned that simple truth into Vanguard, now the largest mutual fund company in the world. And it all happened because he was fired from his previous job. That failure, he says, was the catalyst for his greatest victory. So, what is Jack Bogle's core philosophy? It's that the entire game of active mutual fund management is stacked against you. He's famous for saying that investing is maybe 95% luck and 5% skill. To prove his point about the illusion of genius, he uses a great analogy. If you put 1,000 gorillas in a room and have them flip coins, one of them will eventually flip heads 10 times in a row. In any other field, you'd call that luck. In the fund business, he says you'd call him a genius. He backs this up with some brutal math. Bogle shows that because of the high fees charged by actively managed funds, the average investor ends up putting up 100% of the money and taking 100% of the risk only to receive about 30% of the reward over their lifetime. The other 70% gets eaten up by fees. It's a devastating slow drain on your wealth. Given his track record, people always want to know what Bogle thinks is coming next. He's generally optimistic about the long-term growth of American companies. But he also warns about the challenges like the massive government debt and the unwinding of the Federal Reserve's balance sheet. He stresses that history rhymes and we shouldn't be surprised by another financial crisis. So how does he deal with the emotional roller coaster of the market? He admits that when the market drops 50%, I feel miserable. I get knots in my stomach. His solution? He says he gets out his own books on staying the course and rereads them to remind himself to not panic. He advises everyone to ignore the noise, turn off the screaming heads on CNBC and just get a life. So, what is the Bogle blueprint for success? It's beautifully simple. First, decide on your asset allocation, the mix of stocks and bonds that fits your own tolerance for risk. Then, diversify using low-cost index funds. And finally, and this is his most famous piece of advice, once your plan is in place, don't do something. Just stand there. Don't trade. Don't chase trends. Don't react to the daily noise. He shares his own personal portfolio as an example. He keeps about 60% in stocks and 40% in bonds, all through Vanguard's simple, low-cost index funds and tax-exempt bond funds. It's a no-nonsense, disciplined approach that has served him well for decades. He shares a fantastic story about the writers Kurt Vonnegut and Joseph Heller. They're at a party hosted by a billionaire and Vonnegut points out that their host made more money in one day than Heller made on his masterpiece novel Catch-22. And Heller's reply was perfect. He said, "That's okay because I have something he, our host, will never have enough." That simple idea is at the heart of Jack Bogle's message. It's not about accumulating the most. It's about building a life. And thanks to his lifelong crusade, millions of regular people now have a fair shake at doing just that. Warren Buffett, the Oracle of Omaha. When you talk about the legends of investing, there's one name that stands above the rest. Warren Buffett, the Oracle of Omaha. He's the humble guy from Nebraska who turned a failing textile company, Berkshire Hathaway, into one of the largest and most successful companies in the world. He became one of the planet's wealthiest people through his famous value investing strategy, finding great undervalued companies and holding them for the long term. Tony Robbins recounts the time he found himself in the green room of the Today Show with Buffett himself. He saw his chance and asked if Buffett would do an interview for the book to share his wisdom on how the average person can win in today's volatile economy. Buffett, with a twinkle in his eye, politely declined. He told the author, "I'd love to help you, but I'm afraid I've already said everything a person can say on the subject," and he's right. For decades, Buffett has been sharing his wisdom in his famous annual letters to shareholders. But Tony Robbins pressed him on one key question. What portfolio would he recommend for his own family to protect and grow their wealth after he's gone? And Buffett's answer was incredibly simple and powerful. He said that for the average person, indexing is the way to go. The most famous stock picker in history, a man who built a colossal fortune by analyzing and choosing individual companies, says that the best strategy for most people, including his own family, is to simply buy a low-cost index fund. His advice is to invest in great American businesses without paying the high fees that most fund managers charge and just hold on for the long term. He repeated this exact advice in his annual letter to shareholders, hammering the point home. He was so clear about it that he even published the exact instructions he left for the trust that will manage his wife's money after he passes. The plan? Put 90% of the money in a very low-cost S&P 500 index fund and the other 10% in short-term government bonds. That's it. No complexity, no high fees, no trying to outsmart the market. Just a simple, powerful, and disciplined approach. But does this simple strategy actually work better than the high-priced experts? Buffett was so sure of it that he put his money where his mouth is. He made a public $1 million bet against a prominent hedge fund firm. He wagered that a simple low-cost S&P 500 index fund would outperform a hand-picked portfolio of 5 elite hedge funds over a 10-year period. So what happened? A few years into the bet, the S&P 500 was up nearly 44% while the hand-picked high-fee hedge funds were up just over 12%. The lesson couldn't be clearer. For the greatest investor of our time, the path to long-term success isn't about finding the next hot stock. It's about owning a piece of the entire market and letting it grow. The Oracle of Omaha has spoken. Paul Tudor Jones, a modern-day Robin Hood. When you talk about the greatest traders of all time, the name Paul Tudor Jones is always near the top of the list. This is a guy with an almost mythical track record, 28 straight years of positive returns. He's legendary for predicting the Black Monday stock market crash of 1987. While everyone else was losing their shirts, Jones and his clients made a nearly 200% return for the year. But that's only half the story. Jones is just as famous for his other identity. Founder of the Robin Hood Foundation, an organization that has invested over $1 billion to fight poverty in New York City with the same rigor he applies to the financial markets. So, what's the secret to his incredible decadecade-long success? It all comes down to one core philosophy forged in the wild commodity trading pits where he got his start. He says, defense is 10 times more important than offense. He saw fortunes made and lost in the blink of an eye. And it taught him that the most important thing is to protect your. And that wraps up part 4 of Money, Master the Game. Now you know how to define your personal financial goals and create a plan to actually achieve them, not someday, but starting today. In the next and final part, we'll dive into part 5, where Tony shares how to create a lifetime income plan and reveals insights from some of the world's greatest investors. You don't want to miss it. If you found this video helpful, make sure to like, share it with a friend and subscribe to the channel so you're notified when part 5 drops. Thanks for watching. See you in the final episode.